The World Bank is seeing robust economic growth in the Philippines, but expresses concern about capacity constraints and price pressures. What does this actually mean? To discuss further, we bring in EJ Tubayan of Business World. EJ, the World Bank is saying that there is going to be growth. They're projecting this to be sustained by the Philippines, but they are also noting that the manufacturing sector in particular is hitting maximum capacity. How does government therefore sustain growth or at the very least avoid a downturn?
Okay, so the World Bank expects the Philippines to sustain, its 6.7% GDP growth rate recorded in 2017 until 2019. And the main concern to that outlook is, that productive capacity, since consumer demand has been rising in recent months, and if manufacturing sector can't be able to keep up with that demand, then the pressure will be on them and will be forced to raise their selling prices. Now, the World Bank has actually called for more investments in the manufacturing sector so that they could boost their production base, increase more jobs, which will eventually lead to the manufacturing sector keeping up with consumer demand in the future.
Okay, so you mentioned rising consumer demand as well. Couple that with maximum capacity in the manufacturing sector. All of this might translate to overheating, which the World Bank also noted. What does this all mean for inflation? Let's note, by the way, that NEDA already just reported highest inflation rates over the past 5 years.
Yes, that's true. We've seen the move by manufacturing sectors to raise their prices since, the World Bank actually admitted that there's a risk for the Philippines to have an overheating economy. And we've seen another month with a fresh 5-year high in May. So what the World Bank counted here is, there's a generally good economy that has stimulated consumer demand, and that's on top of the tax reform law where it cut personal income taxes. So, the World Bank's just saying that to keep up with this rising demand, we have to keep all elements in check. Although the Philippines is starting to, invest more in the infrastructure sector, it won't actually be realized until then, because the multiplier sector of these public roads, bridges will all come down maybe 5 or more than 5 years down into the future, because that lowers congestion costs for manufacturing, which will give them space to increase more productive capacity for their manufactured goods.
Okay, EJ, quickly, World Bank projections for the rest of the Asian region, and what does that mean for the Philippines?
Well, the Philippines is expected to grow. I think it's the second or the third fastest growing economy in the East Asia and the Pacific. The World Bank said that the Philippines continues to enjoy a high economic growth rate due to its stable macroeconomic fundamentals. Now, even if that's true, the World Bank says that we still need to expand our manufacturing sector, expand infrastructure investments so that the Philippines could grow even faster in future years.
Okay, that was EJ Tubayan joining us from the News Center of Business World in Quezon City.